Every market participant wakes up to the same problem, predicting where prices will go next while bombarded by a relentless stream of chaotic, real-time data. To solve this, the financial world split into two opposing factions, operating almost like rival tribes. This massive electronic board above the New York Stock Exchange floor is the historical battleground. Here, these two ideologies clash over how capital is allocated. The divide comes down to what you choose to study. One camp focuses entirely on the underlying causes of a market move. The other studies the resulting effect. In this matrix, fundamental analysis studies the cause. Technical analysis studies the effect. Fundamentalists analyze economic reports and supply metrics. Technicians strictly track historical price. The fundamental analyst must know the why. The technician only cares about the what. Choosing the wrong method for your specific style of trading carries a heavy penalty. You can have a brilliant macroeconomic thesis and still face financial ruin if you apply the wrong analytical tool to execute it. Fundamental analysis is a rigorous search for an asset's intrinsic value, what it's actually worth in the real world. To figure that out, you process massive amounts of information. You read corporate reports, analyze macroeconomic shifts, and weigh global supply against demand. The operational logic is straightforward. If the current market price sits below your calculated intrinsic value, you buy. If it's above that value, you sell. This exhaustive research process builds incredible confidence. When you know exactly why you bought an asset, you gain the conviction to hold on to it, even when the broader market turns turbulent. But this approach carries a critical flaw. It tells you exactly what an asset should be worth on paper. It completely fails to tell you when the rest of the market will actually agree with you and push the price to that level. Technical analysis takes the exact opposite route. It studies market action, operating on the strict belief that all known fundamental information is already priced in. Instead of corporate reports, technicians use highly simplified inputs. On this ticker tape, they only care about historical price, trading volume, and open interest. This rests on one premise. Market action discounts everything. If prices rise, demand exceeds supply. You don't need a report to know why. The effect is playing out in front of you. This method has its drawbacks. Chart reading is a subjective skill. It's prone to false signals, and popular patterns become self-fulfilling prophecies when everyone acts together. But the massive advantage is flexibility. Technicians don't need to memorize the corporate details of every company in this chaotic trading pit. They can rapidly scan and trade dozens of entirely unrelated markets at the same time. Technicians regularly have to take uncomfortable positions that defy the financial news of the day. But by abandoning the search for the why, they gain the precise entry and exit timing that fundamental analysis lacks. To evaluate these methods objectively, we can map them on this quadrant chart. On the horizontal axis, we measure the speed of information, from lagging to leading. On the vertical axis, analytical focus, ranging from broad adaptability down to deep specialization. The massive data requirements of fundamental research force analysts to specialize in just one or two sectors, creating strict analytical tunnel vision. Furthermore, traditional economic indicators are only released quarterly or monthly. By the time this avalanche of financial documents hits your desk, the data is inherently lagging behind the real-time reality of the market. Now, let's look at technical analysis. By ignoring deep research, traders remain highly flexible and asset agnostic, allowing them to track multiple markets simultaneously. Market price acts as a leading indicator. The price reacts to the actions of insiders and unknown fundamentals long before those details ever reach the news cycle. Here is the trade-off. Fundamental input gives you deep conviction, but costs you speed. Technical input gives you rapid adaptability, but strips away your objective certainty. There is a hidden variable that dictates which of these methods you must use: leverage. When you trade futures, you're using margin. This scale illustrates how a trader puts up a tiny fraction of capital, often less than 10%, to control a massive asset block. That 10% margin magnifies everything. A minor percentage shift in the wrong direction doesn't just hurt, it has an immediate, oversized impact on your account. The math is brutal. A small, temporary drop in price against your highly leveraged position will completely wipe out your capital, forcing you out of the market entirely. Compare this strictly to unleveraged stock investing. A traditional investor can afford to buy a stock, hold it through a temporary downturn, and simply wait months or years for the fundamental causes to finally play out. In highly leveraged environments, that luxury of waiting disappears entirely. You cannot afford to be early. Precise technical timing stops being an optional strategy. It becomes a non-negotiable requirement for your financial survival. The solution requires breaking your decision-making into two phases. In phase 1, you use fundamental analysis as your filter to determine intrinsic value and select which asset to target. In phase 2, you use technical analysis as your execution trigger for exact entry and exit. Executing this combination is psychologically difficult. At the beginning of major market moves, the charts and the fundamental news will aggressively contradict each other. In those moments, you have to trust the technicals. Price action reacts to events that fundamental analysts simply don't have the data for yet. If you are a long-term stock investor, you should rely heavily on fundamental causes to pick your assets, but you still need to layer in basic technicals to avoid buying exactly at the absolute peak of a cycle. If you are trading with leverage, your priorities flip. You must prioritize technical effects. Daily fundamental data is useless to you because your survival depends entirely on timing. You can technically survive in the markets trading purely on effects without knowing the causes, but it is virtually impossible to survive trading purely on causes without timing the effects.